Thank you very much to ONFIF for the invitation to this Digital Money Institute. I think that the subtitle for the conference today, Operating in a State of Digital Transformation, is very apt, as we are now taking stock of the ongoing investigation and experimentation for potential rollouts of central bank digital currencies, and also the continued evolution of the so-called stable coins as well within the private sector developments. Now, I think that the role that technology is taking in shaping innovation in payments is something that should not surprise us, because I would say it's nothing new. In 2007, for instance, we had the first contactless payments were made across the European Union, similarly revolutionary at the time. The use has accelerated in the context of COVID-19. I just took the tube, pay with my contactless credit card, and not just me, everybody seems to be doing that seamlessly. So our ability to adapt and to adjust to technological innovations may not surprise us, So from commercial bank to electronic money, from online banking to mobile banking, our payments rely on interoperable, resilient, and secure technology running rails. These rails have evolved over time to match our changing preferences as retail and wholesale users use them. However, I think we're now at a point in time where it's not only the running rails that are changing rapidly, but also the unit of payments as well, our instruments of use of payments. Yesterday, I understand that you discussed a lot about CBDCs, but as you know, from research from the BIS, over 90% of central banks around the world are now exploring their potential introduction of their use. So I'm sure you have very rich discussions about this, but let me just I'm not going to go in detail in those discussions, but I'll try to repeat them, but I'll make a couple of points on the digital euro, which obviously is the area that's more relevant for my professional competence. As you're probably all aware, from Fabio Pandetta's remarks, the executive board member of the ECB, who is in charge of this project, he spoke at the ECOFIN, at the Econ Committee in the Parliament last month, and the ECB is now entering the final phase of the investigations for the single digital, on the investigation stage for the digital euro. The next stages, which are design and legislative norms, are on the way. We expect the European Commission to adopt this summer a legislative proposal for a regulation establishing the digital euro in the Union. That proposal is expected to lay down the measures necessary for such a euro, or such a digital euro, to be used as a single currency across the euro area. So it should establish and regulate the essential aspects of the digital euro in full deference of the competence of the ECB, of course, and who is ultimately, as we all know, the one that holds the hand and the final decision whether a digital euro will ultimately be implemented or not on the European Union. But I think that the digital euro should be seen very much as complement to existing instruments for payments in the context of our digitalized economy. Clearly, euros in physical form cannot be used for digital payments, but there are all very good alternatives at the same time. So there are digital counterparts that, without calling the digital euro, the digital means of payment that exists out there. However, I think citizens, in principle, should not be denied also the optionality to use the digital euro if the central bank decides to develop it. So therefore, the regulatory framework is welcome. At the same time, they should also not be denied the possibility of using physical cash if they want to. So I think that the legislative proposal has to come, and the Commission has this in mind, with an additional proposal on the legal tender of cash that should be parallel to the proposal on the digital euro, so that we can preserve the role of cash as legal tender in our economy and to ensure sufficient access to cash and acceptance of payments. As you know, there's strong parts of our society, particularly the political environment, that we perceive that physical cash should remain as part of the options that consumers and citizens should have available to know. Of course, CBDCs, and this is very important, should not come at the expense of financial stability and should not impede the bank's intermediation capacity for the time being. At the same time, should not come at the expense of fighting either money laundering or terrorist financing. So, central digital currencies or any kind of digital currency should not be an excuse or tool to be enhancing financial crime. Now, beyond CBDCs, what about tokens that are used outside the public sector, or especially within tokens, the so-called, in the crypto world, the so-called stable coins? Can these types of tokens also help facilitate responsible innovation in payments? Can they subside, or can they exist in coincidence with the digital currencies if they were to develop? Now, these so-called stable coins, as you know, are intended to maintain a stable value by reference to a single fiat currency or several fiat currencies or other types of assets that are perceived to be stable. In recent years, the use has grown over time. Some are being used as settlement assets. In the case of DLT transactions, very important, particularly for market infrastructure. Others are highly relevant as settlement assets in the context also of decentralized finance. So I think we can imagine a context in which so-called stable coins become even more relevant as a means of payment. First, the development of integration of the central bank digital currencies will take some time. And in the meantime, we have seen already, as I said, market continue to innovate, and these stable coins continue to arise in the market, and potential uses seem to be extending. Now, even more, in a more stable environment with CBDCs being present, different use cases can also be envisaged. For instance, many central banks, my understanding is that, are considering balance limits on CBDC holdings. If that's the case, for certain type of transactions, we may need stable coins that may be better suited for higher value use cases, particularly the wholesale market potentially. A consistent also CBDCs and so-called stable coins, should be coherent, I think, or it will be coherent with our long history of having money as a means of payments in parallel with a number of other private applications that have been used also as payment devices in society. So the question is, can these stable coins, if we push them forward, be a facilitator for responsible innovation in the market? In my view, yes, they can be a facilitator subject to implementation of some sensible guardrails. And I'd like to speak a little bit what I consider to be those guardrails. First, the risk to the effectiveness of monetary policy tools and to financial stability, as I mentioned before, must be effectively mitigated. So central banks should have a power to veto the widespread introduction of so-called stable coins if necessary they affect those ultimately public policy goals. Second, also, I think the design should confirm, the design of the stable coins should confirm to certain futures to mitigate risks of extreme losses of confidence in their ability to store value. Third, risks of money laundering, terrorist financing, as I said before, but beyond that, risk of operational outrages or losses to cyber risk and cyber attacks should be addressed. Also, interoperability between the CBDCs and other means of payment, these stable currencies and other means of payments, potentially CBDCs and traditional cash or other payment devices should also be assured. And fourth, I think that as we go through these organizations, I'd like to come back to this point. I always like to think about the difference between a technology, a product who has a user case, a firm that produces that product or products, and an asset that could be invested as a financial asset. And those are four different things that when we talk about this crypto world, we tend to make difference between them. So far we've been talking about a technology being used to a product, which is basically a payments device, like a stable currency, which we can ask whether it's a financial asset or not. We tend to think that most e-monies are not financial assets. And of course, those are also, in the case of the private sector, have to be delivered by firms that produce those products. Now, when we think about firms, we also need to think about these four areas, which are risk arises from ineffective governance, from conflict of interest, from poor conduct of business, and for poor risk management, which is essential aspects of what those firms should be doing in any aspect, not just in the context of stable currencies, but in any other aspect of financial markets. And a lot of what we have seen over the last year in terms of failures in this industry have a lot to do with these basic principles of how a firm should be operating, rather than with basic issues of governance, conflicts of interest, things like that. And now, these guardrails that I just put forward, I think that by now are well understood and in plain sight for all of us. The Financial Stability Board published already in October 2020, almost 3 years ago, its high-level recommendations for the regulation, supervision, oversight of global stablecoins. These were complementing initiatives that were already that were already pushed forward by international standard setters such as CPMI and IOSCO, and also by the Financial Action Task Force in the case of money laundering. However, I must say 2.5 years later, and now the FSB is reviewing some of these high-level principles, I feel that the progress towards implementing of these recommendations globally has been limited. In the EU, we have made some progress. We're not finished yet with the implementation of MiCRA, the regulation on markets in crypto assets, and that's a good step forward. This is expected to enter into force in July of this year, once it's finally approved and published in the official journal. As you maybe know, MiCRA will establish what's a somewhat holistic regulatory regime for crypto asset services, such as custody and exchange, as well as for crypto assets issuance, including the issuance of the so-called stable coins, which in the terminology of MiCRA, just to make this world more confusing, they're called asset reference tokens and electronic money tokens. By doing that, I think that MiCRA will effectively implement the FSB recommendations in the EU, and that's a step forward. Now, in that case, to issue these asset reference tokens, the user will have to be a credit institution or an authorized issuer of ARTs in the EU. To issue electronic money tokens, the user also must be authorized as a credit institution or as an electronic money institution in the EU. Therefore, all issuers, will be subject to a robust authorization and then also supervisory framework going forward 2 years down the road. Issuers will be required to conform with robust, as I said before, prudential, governance, conduct of business requirements, including the requirement to issue detailed white papers setting out the features, and the risks of the tokens they're proposing to put forward, and robust reserve and redemption arrangements as well. For some of these large asset reference tokens and electronic money tokens, which are determined by us, by the EBA, as being significant in accordance with the criteria set out in MiCRA for the European Union single market, there will be additional supplemental obligations, such as enhanced stress testing of the reserve requirements of those tokens, and also there will be a supranational supervision applied by the EBA that would take on the supervision of these significant asset reference tokens. We will establish the supervisory colleges as well for all the significant ARTs and EMTs as we go forward to ensure there is effective supervision and cooperation in relation to these tokens. At the same time and in parallel, AML measures will be provided. As you know, the European Union right now is discussing a new regulation on AML activities overall, which will involve, again, some supranational European-level supervision of AML activities. In that context, the inclusion of these asset reference tokens and crypto assets is also included. So they will refer not just to traditional financial activities, but also to the new financial activities. Finally, in terms of operational resilience, we have put in place the Digital Operational Resilience Act to try to assess the operational resilience of providers, particularly third-party providers in the financial sector. Again, the crypto world will be included into the as part of potential providers of services in terms of ICT services and operational resilience. As a result of this, I hope that the regulatory action, with prudential requirements, with governance requirements, with anti-money laundering requirements, with digital operational resilience requirements will be comprehensive, and we expect that there will be greater confidence in using these electronic money tokens or asset reference tokens as an interactive payment unit if wished by the citizens and if the business case for those seems to be robust. However, at the same time, I'm very much aware that regulatory supervisory convergence internationally is also a prerequisite for responsible integration of stablecoins, particularly given the nature of this technology and the way it has developed worldwide. Therefore, we will continue to work and encourage jurisdictions to accelerate the steps to strengthen the regulation and supervision of the so-called stablecoins and make them coexist, if necessary, with the potential put in place of CBDCs. So let me just finish quickly with a few comments on what to expect from the EBA in this roadmap that I just put forward in the next coming years, for this year of 2023 and for 2024. As you will not be surprised, in this context, much of our focus will be putting forward what we call the Level 2 regulation, but the detailed regulatory framework, the regulatory technical standards for the implementation of the Digital Operational Resilience Act and Operational Resilience for the implementation of MiCRA, all the authorization regulatory requirements. For the digital resilience what we call DORA. I think you all know what it is. It requires to harmonize the services of third-party providers in the European Union to ensure financial stability, to ensure that the regulators and the supervisors can see through to the whole value-added chain of the provision of financial services in the Union to ensure operational resilience. Originally, this was a regulation that came about particularly by the concern about large subcontracting of ICT activities from financial entities to third parties, and that not only large subcontracting, but two features that were happening at the same time. The large subcontracting was happening in a way by which the subcontractors were much larger than the financial institutions themselves, so this ability for the financial institution to be able to, and supervisors to be able to as well supervise the robustness of the provision of those services throughout the whole value-added chains was being challenged. So that needed to be addressed. Second, also as a result of concentration in the provision of those services, a few number of industry makers, that also results in potential concentration risk and concerns about financial stability due to concentration risk, and that needs to be addressed. On MICRA, we expect, as I said before, the entry into force in early summer, so we'll continue to start working on the intensive phase of policy delivery. We will be coming with a number of regulatory products for consultation throughout this summer, most of them actually throughout the fall, but some of them authorization will already be coming forward in the summer, so we'll encourage you, if possible, to contribute to the consultation to try to make sure that we put forward a framework that is robust and can be implemented, as you know, a year from now in terms of authorization requirements, 2 years from now in terms of supervisory requirements. At the same time, we're working with as you know, or as you may know, the EBA has the role right now on the existing anti-money laundering regime of coordinating AML activities within the European Union. So we are coordinating those activities and working hard to make sure that the AML authorities continue to expand their crypto knowledge and the crypto understanding of the function of this world and exchange information on those bases to try to facilitate that until we have the new AML regime in place. Third area of work, and we're continuing to work a lot, is in building infrastructure, supervisory infrastructure, what basically means enhancing our capabilities, both in terms of mainly technical capital, both in terms of physical capital, but of course human capital. So we've been working hard in trying to enhance our own teams, but at the same time we built, jointly with the other two supervisory authorities for insurance and for asset management, a European Supervisory Academy, in which we are providing training, massive efforts in providing training to supervisory authorities across the European Union mainly, but also open to third countries in some cases, to try to enhance our capabilities in this area, both in terms of the regulatory framework and the supervisory framework. We're also helping, finally, the Commission in the development of new regulatory products in this area as we go forward, particularly with the Digital Service Act and the Artificial Intelligence Act that they're working forward. Finally, as I say, we continue to support our European colleagues in the international debates, and we'll continue to engage proactively in that sense with ongoing policy work that we have at the Basel Committee, which, as you probably know, and we may want to discuss this, have put forward some principles of how, prudential principles of how crypto assets, mainly in this context more than stable coins, but how crypto assets should be treated from the prudential framework by banks, by banking institutions, but also beyond that, the context of the FSB, as I mentioned before, and FATFA as well, the Financial Action Task Force. So a lot of work going, a lot of work coming forward. Much of it, I think, work remains ahead. One of the questions I hear a lot is whether I feel that MICRA is the regulation, and my feeling is MICRA is a good regulation. Right now, it's the regulation that we have. But in a context that is so dynamic as this world in which technology and innovation and digitalization comes into the sectors, it's only natural that as user cases develop, as new products develop, we will identify potential areas for further work and further identification of, as I said before, guardrails to put into the system. In this process, we are very much benefiting from the engagement with the industry as well. We have put forward what we call a European Forum for Financial Innovators and Innovation Facilitators, in which we engage with them regularly. We have also enhanced the composition and the membership of our banking stakeholder group to include some of the members of the industry in these areas to try to make sure that we have the representatives, and that continuous engagement is very important for us. So again, to the extent that some of you participating from the private sector would like to engage through our consultations or through different stakeholder groups and hearings that we have, you're more welcome. Thank you very much for your attention. Thank you for your interest, above all. I look forward to our exchange of views. Thanks.
Take a seat. Good morning, everyone. I think one of the most pressing questions, so let's pick up from where you left off. I think one of the most pressing questions that everybody's trying to understand at the moment is how would a digital euro change the banking landscape in Europe? We've just been through a regional banking crisis in the United States. We may not be through a regional banking crisis in the United States that has been driven by liquidity. The process has been accelerated by the fact that a lot of the deposits have been moved digitally. How would a single euro change the liquidity parameters in which European banks have to operate, do you think?
Well, let me. Is this working?
I think you've got both.
Oh, I got one.
I think you're good to go.
Thank you. I was just speaking. Thanks. No, I was just going to say. Let me back up for a minute because I think digitalization is already. Exactly. We don't have a CBDC in the world, and as you said, there's already been tensions happening over the last 3 months, on liquidity and the challenge the bank hold. I think that digitalization overall basically has put an additional pressure. When you talk to the to the technology guys, the crypto guys, things of that sort, they're essentially, I tend to ask them as a regular, what is your business case? What is your model? What is your business case? So I can try to understand it.
Yep.
And they basically summarize it, we want to facilitate instant payments 24/7, 365 days a year. Yep. Now, a lot of that I think already exists, but they think that they can bring it farther and farther into more and more groups of society. Well, that just gets materialized in the context of sight deposits and banks, that those instant payments can be down 24/7, 365 days a year in a much, much faster way. This is something that we need to learn how to deal with it. I think that it requires some reflection, but obviously 3 things, if I may, the lessons that we have learned already. The first one is that, we need to take out of our minds, I think we all knew, but now we have the materialization. The bank runs are not Northern Rock and people lining up on the streets like it happened in 2008. Bank runs is somewhat different going forward. That's the first aspect. Second one is that the communication by which bank runs take place is taken through a new model that we need to make sure that we're able to understand, monitor, and at the same time get useful feedback from that, which is social network and social media. It's no longer TV, traditional media, but social media was necessary there. And for supervisors, that's important. They need to have the systems and the banks themselves to monitor that and to understand that. Third aspect is that this happens much faster than before. Now, if it happens much faster than before, then we need to reflect upon what does that mean. It could be, we can think of a number of different situations, but basically the way I think about it in a simpler way is that this idea that I have banks which are comfortably sitting around with 90% site liabilities, Yep. And 90% long-term assets, which are illiquid in 20, 30 years down the road, it's a model that's not working. It's unlikely to work. It's vulnerable. It's always been vulnerable, and now it's even more vulnerable. So I think of, well, do I build some kind of, again, guardrails to stop that, to stop that from being that way? Do I ask banks to have a term structure that's not 90% side deposits? Do I ask them to have an asset structure that's not 90%, long-term illiquid assets, which is some of the issues that were there? That's one possibility. Do I put guardrails on the what I call side deposits? As I said, let's many of these CBDCs. I'm sorry, I'm talking for very long. Are in nature, the central banks, I think of them having like certain volume limits. Well, that's a guardrail. That's a guardrail on the digital.
Does that really work? Would that really work?
I don't know. I mean, we're experimenting,
Exactly.
Where we work. But the question is that we need to understand what the underlying challenges are and how do I manage them.
But there would be an acceleration of all the processes we're struggling with now, if we were to have a digital currency. Because presumably you could take your money out of the commercial bank. You would have in theory, a central bank account. This is central bank money, in theory, being used for retail purposes. So therefore, deposit insurance, all these other factors come into play as well. Because you can move your money straight into the central bank account.
You know that there's people that perceive this as a situation which we go to a model in which basically the traditional role of banking as the private creator of money disappears. Okay, that's one extreme. We're not there yet. I mean, the central bank has been very clear, the European Central Bank, that it will not provide access by individuals directly to central bank accounts on this project of the CBDC.
But logically, that's how it could work.
Could work, but we need to step by step. Yep. You know? We need to get there. You know, it's the difference between, I would say, an academic or a visionary is that they see the end point, then you need to walk on the transition of how you may end up to that end point. You know? And we're very much at the beginning of that transition. Yeah.
What is happening now seems to have caught regulators, banks, unawares. We didn't see what we're seeing now coming, or did we?
I'm not sure if it's fair we didn't see, because I'm not sure we have seen yet. You know, we have seen very little. But let's put it this way, you know, a year ago, we were certainly very concerned about the impact that increased interest rates will have on the balance sheets and the business models of banks. We were asking them to assess that, and supervisors to assess that, on the impact that the rising interest rates will have on the sensibility of interest rate risk on the banking book of banks. All that we knew. We're also concerned about the fact that as interest rates were rising after 10 years of very low interest rates in a digitalized world, the elasticity of deposits to that interest rate may have been quite different from before. Now, I think there's a difference between whether you think there is a price differential that encourages people to move deposits between one bank and another, you know, and that just is daily competition.
Or a money market account.
Or a money market account, that's absolutely fine. That's just a price issue. Whether you think there is a confidence issue, and people are withdrawing their money from their bank because they're worried about the fact that their money may not be there tomorrow. It's very difficult. Any price, no price will compensate for that confidence problem. So I think that the first part, you know, the fact that this digitalization will bring more competition, will bring more dynamism, is probably well understood. It's still yet, unfortunately, I don't know if unfortunately I shouldn't say that, but it's yet surprisingly, that's what I meant to say, not yet quite materializing. We see that the stickiness of deposit remuneration remains high. We see that deposits remain relatively sticky across all banks.
In Europe compared with the United States?
In Europe, absolutely. So I mean, we're obviously still less developed in the rise of interest rates. Interest rates are not at the level which they are in the United States.
Give Christine Lagarde time, don't worry. We might get there.
But exactly, we maybe still along that path, right? So that has a matter. The important thing for me is that the confidence problems is not what drives day-to-day perceptions of citizens. There's the price problem.
Yeah, so it's the return on my money rather than return of my money. So just to come back to the issue of liquidity and speed, how would you, unforeseen circumstances, you always regulate in the rearview mirror in certain instances. What are we learning now that we can apply to a world where a digital euro exists? In terms of, I want to focus on the liquidity issues of the banks, because the speed at which money is moving has increased dramatically, and that it's the rise in interest rates, as you say, but also the ability to move money very quickly that seems to have created the problem here.
Yeah, I tend to, if I may, I tend to distinguish between the two items, at least for the time being, because first, we don't know exactly the digital euro, what are the details of the terms in which the central bank will allow people to use it, to bring it to the central bank. So that will have to be worked out. I tend to think about the digital euro as project as now, if I may, more of a payments product rather than like a liquidity management problem. The liquidity management problem right now that we have understood from the projects that we have seen, I think that we have understood some lessons, is that this happens very fast. Second, you know, banks need to be very ready to bring forward collateral to the central bank to much larger amounts than they did before. They need to be very prudent on their behavioral models that they're using to estimate the stability of their deposits. You know? So as a result of that, I think liquidity could become much more costly for banking institutions overall.
Less profitable. I've got a couple of minutes left. Has anybody got a question? I feel I've asked 2 or 3. Gentleman in the middle there. If you could identify yourself first, that would be fantastic.
Tim Massid from the Harvard Kennedy School. You spoke about stablecoins. The U.S. bank regulators the FDIC, the OCC, and the Fed have said that movement of stablecoins on decentralized, permissionless blockchains is inconsistent with safety and soundness. You've talked about the risks of illicit activity and operational resilience, but it does seem, as you said, that under MiCA and Operational Resilience Act, you're moving toward having a system where you feel those risks can be addressed. Am I correct in saying that? And if so, how do you see the regulatory convergence issue evolving on the question of whether stablecoins can move on permissionless blockchains versus permissioned ones?
Yeah. I mean, our regulatory framework right now that has been put forward, it allows the coexistence of these stablecoins. As I said before, it puts a large number of guardrails. So then you need to put, the way we divide the regulations design, issuers need to put forward a white paper. The white paper that describes the characteristics of what they're planning to put forward on the market. The white paper has to be analyzed. The central bank has veto power if they perceive there is a threat to financial stability or to monetary policy. And then depending on the size of the white paper, then regulation and supervision would be, I would call it proportional. If it's a token that has the ambition to be very specialized, focused for a subset of particular groups, think about, for instance, an industry in which suppliers and buyers and suppliers in the value of the chains, they want to exchange payments through this particular token. Well, that's very narrow. That probably will have a narrow regulation. It's something that if we think about more closer to like a digital currency, which is massively being used by a large number of citizens, that would probably require much larger supervisory framework. In that context would be the European Bank Authority. So I think it's those proportionalities. The first, the fact that there's an authorization requirement, so you have to ask, if I might say, for permission. And within that ask for permission, you have to put forward your project. And that project has to be assessed, particularly for the concerns that have been put forward by the EU's regulators, which is the most obvious ones, as I said before, interference with monetary policy, interference, potential risk to financial stability. We'll see how it evolves.
It's complicated. Before I get told off for running completely over time, we are already over time.
Sorry.
No, it's not. Thank you very much. Dr. Camper, thank you very much indeed. We greatly appreciate your time.
Sorry,